This July, a committee of 12 people sat in a room in Washington and decided to do nothing. They left interest rates exactly where they were, for the 5th meeting in a row. 3 of them voted against it, and that one sentence, a committee, disagreeing, moved markets on every continent inside a second. Stocks, mortgages, your savings account, the job you have, and the raise you won't get. Nobody elected most of these people. You cannot vote them out. And right now, the President of the United States is publicly telling them they are wrong. Today, how the Federal Reserve actually works, the printing, the interest rates, the theater, and why the fight over who controls it is the most important argument in economics. Ground rule first. This is education about how a system works. It is not financial advice, and nobody here will tell you to buy or sell anything. A few numbers are rounded to keep the story moving. Every figure and every simplification is documented in the sources below. Start with a question nobody asks: where does your bank keep its money? You keep your money at a bank, but your bank also keeps its money at a bank for banks. That is the Federal Reserve. Every big bank holds an account there. Those balances are called reserves. And when a bank is dying, when nobody else on earth will lend to it, the Fed is the lender of last resort, the only door left to knock on. Hold on to that one job. It explains everything else. Why does that job exist? Because of the year America found out what happens without it, 1907. It started with a gamble. 2 speculators tried to corner the stock of a copper company, buy up every share so anyone who bet against them would be ruined. The corner collapsed, and the banks that had quietly funded it were suddenly known to be holding worthless paper. Now understand what a bank run is. Your bank does not keep your money in a drawer, it has lent most of it out. So if enough people show up on the same morning wanting cash, the bank runs out. Not because it was crooked, because that is how banking works. Depositors queued around the block. One trust company fell, then the next, because if that one could fail, why not this one? Fear was the contagion. Within days the New York Stock Exchange was close to shutting its doors, and the whole country's payment system was hours from stopping. There was no Federal Reserve to call. So the man who stopped it was a private citizen, J.P. Morgan, 70 years old, the richest banker in America. He summoned New York's bankers to his own library, locked the doors, and refused to let them leave until they had pledged their own money to save the institutions still standing. It worked. And it terrified Washington, because the country had just been rescued by one elderly man who happened to be rich enough and stubborn enough, and who would not live forever. 6 years later Congress built a permanent replacement for him. 1913, the Federal Reserve. Put it on a timeline and central banking is an old idea that keeps escalating. 1694, the Bank of England, invented to fund a war. 1913, the Fed. Then 1971, and this one deserves a moment, because it is the reason money works the way it does today. Until that year, the dollar was a claim on metal. Foreign governments could walk up with dollars and demand gold at $35 an ounce, and America was obliged to hand it over. That promise is what capped the printing. You could not create dollars faster than you could back them. But America had been spending, Vietnam, social programs, and by 71, foreign countries held far more dollars than there was gold in the vaults. France started cashing in. Britain asked for $3 billion. It was a bank run on a country. So on a Sunday night in August, President Nixon went on television and closed the window. No more gold. He called it temporary. It was permanent. From that day the dollar has been backed by nothing you can hold, only by trust, and by the restraint of the people who control the printer. That is the entire reason the rest of this video matters. 2008, the Fed starts buying assets by the trillion. They call it quantitative easing. And 2020, the fastest money creation in American history. Each crisis taught the machine a new trick. None of the tricks ever got retired. Now the part school never taught you, where money actually comes from. You deposit $1,000. The bank keeps a slice in reserve, say 10%, and the bank lends the rest. $900 walks out the door. The borrower spends it, and that $900 lands in another bank, which keeps $90, and lends $810. And it happens round after round, smaller and faster every time, until your $1,000 has become $10,000 of deposits people can genuinely spend. Only the first 1,000 was ever printed. Everything above it, the difference is debt. Almost every dollar in your account started life as somebody else's loan. Banks don't just store money, banks create it. Add it all up, the cash, the checking accounts, the savings, and you get the number economists call M2, the money supply. Watch it climb. Slow, steady, decade after decade. Then 2008, quantitative easing begins, and the slope changes. Then 2020. In roughly 2 years, about 1 in every $4 in existence, was new. It dipped once, in 2023, the first real contraction in modern history, and then went straight back to climbing. Today it stands above $23 trillion, an all-time high. Keep that chart in your head the next time somebody calls the prices of the last 4 years a mystery. But be precise about the word printing, because almost none of it is paper. When the Fed wants more money in the system, it buys bonds from a bank. It pays by typing new reserves into that bank's account, numbers that did not exist 1 second earlier. The bank has fresh money to lend. The Fed holds the bond, and its balance sheet grows. That is the whole machine. No press, no ink, the money printer is a keyboard. All that power funnels through one number, the federal funds rate, what banks pay to borrow from each other overnight. It is the only dial the Fed really has. Watch what happened when they turned it. In 2 years the dial went from the floor to 5.25%, the fastest hiking cycle in 40 years. And the move rippled out through the system, one market at a time. Mortgages nearly doubled. Car loans, credit cards, business loans, even your savings account finally paid something. Always last, and always least. One number moved, and everything repriced. Nobody asked you, nothing you own was consulted. Today that dial sits at 3.5%, and the argument inside that room is whether it should go back up. So why raise it? To cool the economy on purpose. Expensive money means fewer loans. Fewer loans mean less spending. Less spending means businesses stop raising prices. Inflation cools. But follow the chain one link further. Less spending is also someone's disappearing customer, and then someone's job. That is the honest, ugly truth of a rate hike. The cure for inflation is making the economy hurt. Cut the rate, and the film runs backwards. Cheap money, easy loans. Spending everywhere, hiring everywhere. It feels like a miracle, for a while. But money that costs nothing flows into anything. Stocks, houses, crypto, startups with no product. That is how you get a bubble. And every bubble of your lifetime was born in a year when money was cheap. So the Fed lives stretched between two promises written into law. Keep prices stable, and keep employment high. The trap is that the dial only turns one way at a time. Fight inflation, and you cost people their jobs. Chase jobs, and you feed inflation. Every meeting is a choice about who hurts. Remember that the next time the chair calls a decision, quote, data dependent. Now you can read the strangest chart in finance, the stock market on Fed Day. All through a quiet afternoon, tiny moves, the entire market holding its breath. Then 2 o'clock, the statement drops, and within 1 minute more shares change hands than in the previous 3 hours. Nothing about the real economy changed at 2 p.m., only words changed. When one committee's sentence moves everything this hard, you understand why the whole world stops to listen. The words have their own history now. In 2021 the word was transitory. Inflation is transitory, don't worry. That single word aged so badly that then Chairman Jerome Powell retired it on live television. 4 times a year, traders study 19 anonymous dots, the dot plot. Each dot one committee members guess at the future of the dial. Billions move on the position of a dot. There is even a name for the Fed's dialect. Fed speak, language engineered to be unquotable. When your sentences move trillions, you learn to say very little, very carefully. And if this still sounds like a Wall Street story, check your own life. Your rent, set by a landlord watching mortgage rates. Your car payment. Your credit card. The interest your savings finally earn. The job offer that existed because hiring was cheap that year, or the layoff that happened because it wasn't. You may never watch a Fed meeting in your life. The Fed still attends every financial decision you make. Which raises the obvious question, why not let presidents control it? They are elected. The committee is not. Here is the trap. Every election, the winning move is cheap money now, a boom timed for November. The bill for that boom is inflation, and it arrives after the votes are counted. Nixon proved it. He leaned on Chairman Arthur Burns to keep money easy into '72, won his landslide, and handed the country a decade of inflation. Politicians live in 4-year loops. Money does not. And if you think that lesson is safely in the past, hold that thought. Breaking that decade took a man with no election to win. Paul Volcker took the chair in '79, with inflation running past 11%, and did the unthinkable. He pushed rates near 20%, on purpose. It caused a brutal recession. Businesses died. Farmers blockaded the Fed with tractors. He did not blink, and by '83, inflation was broken, and the stability that followed lasted a generation. No elected politician could have survived doing that, which is exactly the argument for never handing them the dial. And if you want to know what happens when the printer answers to politicians, history keeps receipts. Weimar Germany, 1923, prices doubling every few days. Argentina, a rich country with a century of printing, watched inflation hit 211% in 2023. Every hyperinflation in history opens with the same chapter, a government that could not say no to its own money printer. But Argentina also proves the reverse. Stop the printing, take the pain, and it comes down, from 211% to around 30% today. Brutal, contested, and real. The machine works in both directions. What decides which way it runs is who is allowed to touch the dial. Which brings us to right now, because this is not a history lesson anymore. In May, the Federal Reserve got a new chairman, Kevin Warsh, nominated by President Trump, confirmed by the Senate 51-45, one of the narrowest votes for a Fed chair in modern memory. At his own swearing-in, the president said he wanted him totally independent. Weeks later, the same president called the Fed's board hostile, and said they were doing the wrong thing. Warsh has said publicly that he will set rates on the data, and ignore the pressure. And this July, his committee held rates steady, with 3 of its own members voting to raise them instead. So the honest answer to how independent is the Fed, in 2026, is, we are finding out, in public, right now. One honest caveat before the recap: the dial is powerful, but it is not magic. The Fed cannot drill oil, end a war, or unload a container ship. When prices rise because supply broke, rate hikes only add pain on top. It cannot spend money into the economy. Only Congress can do that. And every move arrives late. A rate change today reaches your paycheck about a year from now. The most powerful economic institution on earth is steering with a delay. The machine, in 60 seconds. The Fed is the bank for banks, born from a panic nobody could stop. Banks create money by lending it. Most dollars are somebody's loan. The Fed steers it all with one dial, trading jobs against prices with every turn. Markets hang on its words, because the words are the policy. And it must stay independent, because every government that ever grabbed the printer, printed. That last one is not settled history. It is being tested this year. Next time that sentence drops at 2 p.m., you'll know exactly what machine just moved, and what is being argued over. If this changed how you'll hear the next Fed meeting, subscribe. Next time, the quiet machine on the other side of the ledger, how government debt actually works, and who really owns it.